Welcome to the Broken Pie Chart Podcast, episode 242. I'm your host, Eric Moore. With me once again is my semi-permanent co-host, Jay Pestrichelli, CEO of ZEGA Financial. Jay, I'll call this a special edition because due to travel, we're actually recording on a Tuesday. So we'll either sound really smart or really dumb by the time people listen to this, but it's going to be good stuff.
I'm leaning on the dumb side, but who knows? We could surprise people.
Well, it would be the first time. So let's this market. All right, we got to talk a little bit about yields, and maybe this title of this episode should be: Did the Fed finally break something? Let me kind of start off though in Austria. Why Austria? Tracy Alloway from Bloomberg had put out a chart of the Austrian 100-year bond. That's right, Austria issued a 100-year bond. So if you buy it in 100 years, you'd get your principal back. Of course, you could sell it in the market. What's interesting, though, Jay, about this one is this was issued, I believe, pre-2017. We all know that yields went lower and lower and lower. And we know that the longer duration there is in a bond, the more impact from a change in rates, up or down. Well, this bond that was issued at $100, basically you pay $1,000 per bond. Trading at 100 is the price, is the quote. Jay, this one got up almost to $250, meaning it went up 2.5 times. So you spend $1,000, you now have $2,500 almost. Jay, today that bond is trading at $600, down 75% off the highs.
I mean, it's really been a wild ride on this, right? And we've talked about in the past about how infinite duration kind of maps like stocks, right? If you think about how the market did in 2018, 19, 2020, 21, right? Like we had kind of a double in the stock market during that time frame, right? And this bond does kind of that. But you're totally right, man. Like after this drop that you saw from 250 down to $60 on this bond, yeah, that's pretty dramatic. It's just so much leverage in the rate of change of those prices. I mean, you had all the upside, and now you're getting all the downside of rates changing. Austria, place for bond trading.
Well, but good for Austria for issuing the bond, because for the next 100 years, I don't know what the coupon is on this. It's probably like 2% or something. I'd have to look that up. A lot of people were critical of our government because they said, well, we should have bought back debt. Well, number one, there's no call provisions on treasuries. But other people said, well, why didn't you issue a lot of long duration bonds when yields are really low? And no, they did not do that. So I don't know. We can move on though, unless we do have listeners in Austria, so this might be of interest to them.
This is a good one. I think it just shows like how extreme, what extreme movement you can have in a bond market as you add more duration. I mean, this is about as extreme as it gets.
By the way, Jay, we've mentioned things like TLT on a price basis only, so not a total return basis. When you have a bond ETF, really you should count the dividends that you get because those bonds are paying coupons. Jay, on a price basis, it hit, I think, a low level not seen since July of 2007. Again, it's paid interest over time, but there's a lot of carnage in the long end of the bond market right now, Jay.
Oh, yeah, to say the least, right? I mean, that I think that's the thing driving all the volatility in the equity market too. It's interesting, Derek. Typically, maybe not typically, everybody I think is taught, stocks and bonds will kind of act and behave in a little different manner. But when you look at, say, TLT versus, I don't know, the SPY or the QQQ right now, they are moving together in the negative direction, right? So if you sought safety in bonds right now, I think you're probably a little disappointed.
I mean, maybe this is, I'm going to ask you a question. Did the Fed finally break stuff? I mean, we always say that we're going to keep rates high, we're going to keep raising until they break stuff. Did they break it?
Well, I mean, it seems like the bond market is finally, believing the Fed that they're going to leave rates higher for longer. I think we talked about this last week, right? We're starting to see maybe some cracks. Just everybody's looking around locally, what they're seeing. Yeah, I think. Look, this is what the Fed has been waiting to do, and the consumer has been so strong. It's just taking more time, and by them holding pat with, not lowering rates because they haven't found a reason to do it. Actually, they're still talking about, maybe another raise, right? I think last week Kashkari talked about it. I think this week we've had other Fed governors talk about, there's probably one more raise. Even this morning, I saw somebody, what is her name? Messer? Oh man, I don't want to botch
Barkin? Not Barkin.
that.
No.
Now I got to look on Bloomberg because that's where I saw it. But yeah, there's another Fed governor out there saying, there's probably one more raise in this. So I do think that, you're starting to see the impact of expensive money on the economy. And I think the market is now, grasping with that, digesting that a little bit. That's what it seems like. So have they finally broke something? I don't think they did anything specifically to break anything in the last, 2 months, right? August and September. But maybe the market's finally realizing, like, okay, higher rates aren't the greatest.
I want to get to correlations, but you mentioned sort of the idea of rates and specifically the long end, Jay. The yield curve, if we look at the yield curve, beginning of September versus today, the yield curve is the back end is getting higher. The front end got a little bit higher too, but we're seeing it get flatter. And by flatter, I mean long end yields, the 5, 10s, 20s, 30s are closer to the 1 year and in. And before it was more steep. This carnage, I shouldn't say carnage. Well, maybe. Long bonds are definitely selling off right now. But Jamie, we mentioned it last week on the show, Jay. Jamie Dimon said the world's not ready for 7% yields. Like, if this un-inverts, what does that really mean? It's either a good thing or a bad thing, and I'll tell you which one it is when I know, right?
Yeah. Well, that is the standard Derek position. But I think it's interesting that you and I have been talking about this. I think we've both been on the same side of this. I wish we could argue about it, but I think we agree that there's two ways that the yield curve could, un-invert, right? Get back to a normalized curve. The near end could come down, or the long end could go up. It's starting to look like the long end could go up. It's something you and I have warned or talked about as a real possibility here. Definitely not patting ourselves on the back because we're not right yet. But the trend, the way things are going, that is definitely showing that. And actually, it's interesting you say Jamie Dimon, because I almost feel like he's the one that started getting people to pay attention to the world's not ready for 7%, versus when Powell has said it, although Powell hasn't said the 7 number. But yeah, I think things have really started to heat up since Jamie Dimon gave that interview. At this point, it's probably a week and a half, 2 weeks ago. I think it's really started to create some concern at the long end of the curve. So look, if this reinverts where the long end surpasses the short end, that's going to bring a little damage to it. That's going to cause some damage in the markets in the short term. Most likely. What do we know? But it feels like the way it seems right now.
Well, Cam Harvey is the one who came out with the 10-3 yield curve inversion. So that was I believe it was his doctoral thesis where he went out and he sort of looked at data and he said every time the 3-month yield inverts and is greater than the 10-year yield, that has preceded every recession. And since he wrote his paper, I think it's the last 8 for 8, if memory serves me. And what we've been seeing is that inversion was at a historic level, meaning the yields on 3 months were greater than the 10-year yields by a higher margin, a greater margin than any time in history. What we've seen recently with the back end sort of steepening is that is getting, more or less inverted. And the interesting thing about this, Jay, is it's one of these things. I'm not saying we're going to have a recession, but it is interesting because every time it has inverted and then uninverts, then you get the recession, Jay. So, like, are bonds trying to tell us that a recession's coming? I don't know.
Well, all right. So let's get back to at least the position I've taken is I don't really care so much about the recession. Of course, there will be one eventually. I care how the market is reacting. The market's usually ahead. And so when I look at what's happening here, if this sell-off continues, I don't know, what are we down, Derek? 9% off the high earlier in the year, right? If we really do see kind of one of those, minus 15s, minus 19s, which sometimes happens when the fear of a recession starts to rear its head, that tells me, by the way, not making that prediction, we're only halfway there. That tells me that, we see maybe that recession 6 months later. So let's say, I'm just going to throw a scenario out there. Let's say we continue to see this downdraft. October turns out to be just as nasty as September. And we kind of bottom out and get one of those kind of October bounces, maybe go into a Thanksgiving rally kind of a deal. A recession 6 months later would not be unusual with the way that the market reacts. So I think that's a scenario that might play itself out in the short term. So, if, when you think about what that all means for us, and I didn't want to get into this right away, but when you think about this, right, bonds continue to drop longer into bonds values drop, yields go up. It's one of those things that I think you need to be prepared for that as a possibility. The market's definitely feeling a little squirrely, as you and I would say at this point.
It would almost be funny, and I say funny with a smile on my face, that everyone was calling for a recession for a long time, and the recession never came. And maybe we had one, and the NBER just hasn't designated it yet, and it was a mild one. But it would sort of be apropos with how the predictions go, that just when everyone was saying, yeah, the Fed did it, we have a soft landing, no recession, the economy's too strong, jobs are too good, and then a recession comes. It would almost be funny. And I'm sort of being sarcastic about it, but nobody knows anything. And people go on TV all the time.
Well, I mean, it would be par for the course, right? The market will seem to frustrate the most people, right? And everybody waiting. And as soon as they switch sides and it turns around and gives them what they were waiting for, but they just couldn't wait it out. I mean, that happens to everybody, no matter, who you are, right? It's hard to predict what the economy and the market is going to do. It's just difficult. And the best of them can't get it right.
You mentioned, and by the way, part of the thing about making predictions is if you make an outlandish prediction and you get it right, you sort of eat for free for the rest of your life. And I always go back to Elaine Garzarelli in mid 1987 called
That's
for
right
a crash.
Where I go to, right there.
Yeah.
I'm just kidding.
Yeah.
Go ahead.
Are you making fun of me because I know random stuff?
Listen, I would never make fun of you for that. It's just not something that I would go to. So great job on you going right to Elaine Garzarelli.
Elaine Garzarelli.
See, I don't even know where I'm supposed to go.
Do a search on Google later, but limit the years to like January 1st to December 31st, 1987, and look it up. She was interviewed by the New York Times. I think it was the Times, where she was saying, this, and this is problematic, and I think we could see a crash, and then it happened. So, that's, but if you go on TV and say, I don't really know. Ralph Akinpora, he was a famous technician.
I know Ralph. That one I know, Derek. I know famous technician.
Well, you may remember we had events at TD Ameritrade, and Ralph was the featured speaker.
Sure,
and
of course.
Somebody asked him from the audience about something. He was telling a story about how one time one of the nightly newses called him, and they said, what happened? And he said, more sellers than buyers. And he said, well, after that, they didn't want him to come on and talk. I think that's the story I remember him telling.
I feel the same way whenever you say more sellers than buyers, by the way.
So that started, though. So that was before I heard that from Ralph Akinpora. That started, Jay, because, years ago, before the internet, before everything, when I was on a trading desk, people would call and they'd say, why is the stock down today? And we had no news. We had nothing. We saw the prices and we put trades in. And that was my thing. When it was up, I'd say, I don't know, more buyers than sellers, more sellers than buyers. That's it. And some people would say, oh, okay, good. I don't know. They bought it. I don't know what to tell you. I mean,
forget about what's causing there to be more sellers than buyers, but there you go. I guess that's good enough.
All right. Speaking of sellers and buyers, bonds are down, stocks are down. I'd say over the last 2 weeks. You mentioned correlations early, and a lot of people had written about, is the 60-40 portfolio dead? And I say, yeah. I wrote about it in my book, Broken Pie Chart, available on Amazon today, and I think it is problematic. But with rates coming up again, people are saying, oh no, it's not dead. Now that 40% of your portfolio, you're actually getting paid. You're getting paid to have that. But the challenge, though, is correlations. And what we're seeing right now is that, as you nailed it, Jay, I mean, stocks are down, bonds are down. In fact, if you look, there was a chart put out. This is from Jesse Felder on Twitter, and I think he was retweeting Julian Brigden. I like to try and give credit when I can, when I remember it anyway. So over or historically, there's a lot of times where bonds and stocks have anti-correlation, or they're non-correlated, meaning stocks go up, bonds go down, and the inverse. In 2008, treasuries rallied when the market was down, that flight to safety. But when you look recently, and it's really an inflationary period, so the late, let's see, well, this is actually 90 to 99, correlations were closer to 1. Inflationary period right now, starting with, we won't say the C word during the illness. We don't want to get the blue check marks on our page there. And we've seen really correlations when you don't want it. So I think what's problematic in a rising rate environment where maybe bonds rates and bonds selling off is causing problems in the stock market, the thing that's supposed to protect the portfolio maybe isn't as reliable.
Yeah, so to what you're talking about here is that the price of bonds and the price of stocks, right? So when they are correlated, that means when one goes down, the other goes down as well. When they are inversely correlated, they go the other way, right? When stocks go down, bonds go up, or vice versa. And it's been historically, like, modern portfolio theory tells us the whole point of holding 40% bonds against your 60% stocks is that, look, bonds are going to pay you maybe not the same rate as stocks, but they're going to act as a buffer or a deadening vehicle if the market gets bearish on you and as a sell-off. Then your bonds are going to A, remain stable and pay you a dividend, and B, they could probably go up in that environment because there's a flight to safety. And that definitely, you're right, has existed. And when I look at this chart that you were nice enough to send me ahead of time, for the most part, all the way back to 2000, in the early 2000s, that was the case, right? Where there was an inverse correlation between the two. But recently, you're right, in these periods of with inflation, there is they are positively correlated. And am I reading this right, Derek? That we're at like 0.3 correlation, right? So that means that's it's not a high confidence number yet, but they are correlated right now recently. And we're definitely seeing, as stocks go down, bond prices are going down. I think the good news here is, if you look back, there's a chance that this kind of breaks over time. And then it flips back the other way. So I'm with you, and I don't know if you said this exactly, but yes, you're getting paid, a dividend or a yield for holding bonds, but your underlying price is probably offsetting that to the negative, right? The loss of the underlying bond price is more than the yield you've been paid. I think the aggregate bond index, the AGG, is negative for the year to the tune of 3%. That includes its dividends, right? So again, I'm with you, Derek. This might be another year where 60-40 again fails to produce the lower volatility or the superior returns to an equity portfolio, or like we do, a hedged equity portfolio, where we think there's a better way to lower volatility through the use of options. That was my little pitch for buying hedge.
I'll just point out, I called bonds a doorstop when rates were near zero. And the reason why they're a doorstop, because if they were in the portfolio, they're giving you nothing, and basically you might as well have had just cash. It's essentially holding cash. Now, bonds are yielding something now. And we know in our hedged equity portfolios, we use very short duration treasuries right now. In other strategies, we're using treasuries where you're starting out with over 5% in something that's a very safe asset. But when correlations, I think that the point on correlations, like you look at the taper tantrum, correlations were anti-correlated, I'll say, or non-correlated, and all of a sudden they become very correlated. The German Bund blow up. I won't get into that, but went from low correlation to high correlation. Inflation spike in, I think that was probably 2019, 2020, quantitative tightening. All these times that all of a sudden things become highly correlated. It's like when you need it most, sometimes it fails you. But I don't know. I mean, to me, like the reason you hold bonds is because you want something that's going up when everything else is going down, or something that holds steady. And to your point, Jay, if you have hedges in a portfolio, like why not own more of the market, but maybe accomplish the same thing or maybe better or similar by just being hedged?
Well, and we, like you said, we do use bonds in our portfolios. There's a use for them, right? They can be a utility. I think the philosophy or maybe the investment strategy that we're saying may not work again, may be a symptom or of the broken pie chart, as you pointed out. Might just be the funds that look to have kind of the regular rate of return. But for us, yeah, there's a specific use for them, especially when you're holding a treasury to maturity, right? You have a specific goal, and if you have if the strategy is to hold it because it's designed to pay for something, I think that's a little different than what we're talking about here with correlations. So, look, we certainly use them. They have returns today. They're a lot better utility than they were in the past. But just, again, beware. But look, I think like if somebody said to me like, hey, I want to get out of this market, I want to cash in my hedges, and I'm ready to kind of sit on the sideline. If I couldn't talk them out of that, then the obvious answer is, well, at least let's buy you a 6 month treasury, right? You're not taking a ton of risk here, and you're going to get paid over 5% these days for that. So I think it's an alternative.
Much better than your 0.01% in your bank account, Jay.
Oh, I still left my money there. Gosh, I got to move that out of my cheese. It's like the plumber with the leaky faucet. I just got to take care of my own house. I'm just kidding. I've moved most of it by now, Derek. So just so you know, I bought 3 month treasuries.
I was going to schedule a session with you, Jay, but apparently advice is. All right, let me move on from this because I know we have some other things to cover. One thing I thought, just on yields, okay, I lied. We're going to stay on yields for a second. The 30-year treasury is 4.94% last time I looked, the yield. I mean, we're getting close to 5%. It was under 1 back in 2020. If you would have bought a bond, a 30-year brand new off-the-rack bond in 2020, it's probably off 60% now. I haven't looked. But yeah, I mean, it's 5-year yields. What is 5? 5 is, 4.8, 10-year 4.8. And yeah, I mean, you're seeing the 20 years a little bit of an anomaly because there's not a lot of volume there. That always has sort of a kink. But that one is 5.1. So, and even look at the short end too. I mean, think about this. For years, you got nothing on your money. 3-month bonds are 5.5%. Treasuries, US Treasury bills. 6-month are, about 5.6%. So, yeah, there is an alternative. Remember, it was the TINA trade. I don't know what the acronym is for. There is an alternative. There is an alternative. TIAO. Is that a word? TIO? I don't know.
It is now.
It is so. All right, Jay. Other things to take a look at. The news isn't well. All right. So I think this is Ben Carlson. I put this out on Twitter, and he put a table, and he said the starting interest rates versus the stock market returns since 1926. And let me set this up. So, for example, when the starting yields are 4 to 6%, 1 year later, the market is up 6.3%. 5 years cumulative, up 34.7, up 77% plus 10, and plus 420% 20 years out. What was interesting about this, and that's sort of where we are now. By yields, we mean the 10-year. When you go up and it's 6 to 8% or 8% or higher, like the returns plus 20 years are really good. And by the way, 0 to 2%, post 0 to 2%, returns are really good. Like the market seems to do really good. I mean, there's some of this though, Jay, that like was the market really, really low that they had to lower yields to 0 to 2%. And so you're starting at a low base. Like, I don't know. I think the good news is it seems like markets are usually up all the time based upon looking at this.
According to this, it's always up. Yeah, right.
You kind of have to couch this a little bit.
Yeah, I do. When I looked at this data, so thank you for providing it to me the full few minutes before we started today. By the way, I've been asked multiple times, does Derek really not, you guys really don't prep, right? And my answer is no. Like we look at you do put together some material to cover and then we just start. So anyway, when I look at this, so you're right, there is a little good news here that, hey, if the 10 years between 4 to 6%, the average 1 year return after that is 6.3%. That seems pretty good. Incidentally, I think that's right where we are now, right? Like, is that where the market is? About 6%, 7% up for the year? We could take a look at it. I didn't see after today's not great sell-off here on October 3rd. So, yeah, that's not bad. But every other rate environment seems to be a little better, right? And the farther you get away from this 4 to 6, it seems to be kind of the anchor. It gets better, right? So if you start the year between 2 to 4%, the 1 year return is actually double that, right? 6.3 compared to 13.6. So I guess I'm while this seems kind of encouraging, I'm not all that encouraged that the environment that we're in seems to be one that, if any scenario is going to be more challenging to the market, it seems like it's this. I would also say, Derek, you're probably right. Like by logic, you would think that an 8% or 9 or 10% 10-year environment probably means the sell-off's already occurred and you're in a rebound phase, right? So you're right. I think it's, you don't know what happened leading into each one of these years. I think that would be more interesting to see the, minus 1 year, like what happened the year that ended at rates at 8% or higher. But that's my feedback on this. So you're right. I think it's a little cherry picking, but even with the cherry picking, this isn't all roses. It doesn't look great.
By the way, that's why we hedge. I mean, neither of us. I mean, we talk on this show, and we sort of give what we're thinking in the moment, but it doesn't change really anything that we're doing. I mean, the core thing we do is to buy and hedge. Or buy and have buffers and things like that. So, neither of us is saying, yeah.
The only thing we can really control when it comes to investing is the risk we take. Right. That's all we can. We can't control the outcomes. Right. I mean, I go back to my days when I was, pretty high up on the ladder at TD Ameritrade, definitely in one of the top 10 people there. And I knew every single thing that was going to happen in that company. And our stock price, I couldn't tell you what it was going to do. Right. You just don't know all of the factors that are going to impact the market. And so you're right. It's one of those things, Derek, that it's why we're always managing our risk. And for us, the best way to do it, we still like to stay invested. We still like to follow the long-term trends of markets go up over time, but you never know when you're going to get a 2020 or a 2022 that is going to rock your world a little bit. So that is why we manage risk through hedging.
Sometimes when it's hardest to stay invested is when you're rewarded the most. And part of the ability to stay invested can be the ability the fact that you have hedges on. We've seen over and over again that individuals who panic, who try and time markets, just, they sort of miss out. And I know that social media and anybody says, well, I got this right, I got this right. You're not seeing people's audited, performance returns for every account that they have, all these claims that people make. And you and I mean, well, especially me, I'm critical to people who every 6 months come out and say the sky's going to fall and we're going to go down 80%. They've made that same prediction every 6 months for the last 10 years. So, yeah, I mean, be hedged, be invested. All right, Jay, let me go to. All right, I guess we.
Hey, Derek,
Yeah.
I'm gonna pull an audible on you as we're sitting here. I'm watching CNBC on my other monitor, and I see that Representative McCarthy has been removed from the speakership of the House. He is no longer Speaker of the House.
Does that matter for the markets? I don't think
Well, I
so.
think it shows instability. I think you got the whole, oh my gosh, can we trust the stability of the United States? Does that push yields higher? Probably. Yeah, I think it probably, it's not so much that, who's in matters, but I think it'll probably add to a little fear and volatility. But no, I don't think in the long run it matters at all. And when I mean long run, like the medium run, like in the next few months, it doesn't matter. But I think we may see little reaction in the market from that tomorrow. Just a guess. We'll see when this comes out if that actually happened or not, or if it's complete, opposite reaction, and that was one of the last shoes to drop. I don't know. We can maybe talk about the rule of three that you and I have I've always bounced around a little bit. I'm not sure if this fits in there or not. Maybe instability in the government might be one of them.
Or could it be oil prices and the strategic petroleum reserve, Jay? I did have a chart in my notes to you. According to this is LSEG data stream and Reuters. This is from September 28th. 17 days is the days left in the SPR right now. The average is 32.
Baffled by this. I am baffled by this. Like, how is nobody talking about the SPR being virtually depleted? Like, this is just fine. Strategically, we don't care anymore. Again, you were ahead of this one to point this one out, Derek. So thank you for continuing to bring it to light. That So I'm not so worried about the safety of America. Don't get me wrong, but I do think this is a thing that will push inflation higher. Right? It's going to have to. While oil is kind of taken out of the core number, it's certainly in the headline number, and you can't help avoid the ripple effects of higher oil and gas costs, especially as we're going into the winter.
Are they still actually draining this? I'll have to look at that. I didn't do my homework for that. But I'm like, really? Are they still emptying this to try and keep prices low? That seems, but it never works. It never works. And so over the long term, the data says that Biden's done this, George W. Bush did this, other presidents have done this, where you sort of release oil into the marketplace. And the idea is you bring on new supply. And you might see a temporary blip in prices, but it really doesn't matter. And so 17 days is not nothing, but it just means if we ran out of oil and we just used what's in the SPR, according to this chart, over the next 17 days, we'd have it, as opposed to having it for 32 and a half days or something like this. But Jay, Brent crude is over 90 now. That's not insignificant. I don't know. Like, did the Fed break something in its oil or maybe the U.S. government broke it? I don't know.
Yeah, it feels like not a non-Fed related breakage here to this. Wow, we're getting a little bearish, Derek. I feel everything we're talking about here is trouble ahead. Why don't you give me any good news in the list to talk? We just did, and I didn't like it either, did I?
I mean, should I skip over the Johnhusman data? I mean,
oh no, let's hit everybody up on that one because it's been a while since we've talked about that. Let's just get it all out there today.
Yeah, so Johnhusman runs. He posts a really, really long, in-depth pieces where he's looking at macro stuff and he's looking at different measures. He puts out a chart, and it's the estimated 12-year S&P nominal annual total return. And so the way that he puts this out, there's two lines. If you could see this, you'd see two lines. There's a red line, the blue line. The red line stops, and it stops at this point. It's right around, I don't know, 2011. And the reason why that is, that tells you what the actual, from that point forward, annualized 12-year future return was. Today, as of October 3rd, it looks like basically his forecasting 0% annualized yield here to 12 years from now. And then if you look back. So, I mean, kind of these two lines kind of match up. And so, I mean, and this is sort of a reason I bring this up. And this seems like it's like, oh, sell everything, sell it. No. This actually supports being hedged, because if you believe this, if you look at these numbers, you would say, well, at some point you probably have a pullback. But if you're hedged, it's a good way to sort of not maybe take those big drawdowns. But I don't know. That's the way I see it, Jay.
Yeah, I mean, so right now, when you look at this, it says the last 12 years, the annual average return on a nominal basis is what, around 9-ish, right? Because it looks back 12 years and says what's been the average return. Am I accurate in saying that, the 12-year period, right?
Yeah.
Yeah. So you're right. We don't know what the 12-year look back will be, after from here, right? So when it's very interesting to look, and it's not a straight down line, but it is kind of a downtrend. So what it means is when you look at this, if these lines were to kind of reconverge, and there's been a little divergence in these two, right, where the actual returns have kind of separated from his projection, is, we may have a few years at 8%, a few years at 6%, 4%, all the way down. So yeah, it's not an immediate, like from today for the next 12 years, this is projecting you'll make 0 per year, but it says that you should expect a reduction in return going forward after the very high rates that we had, for over the last 12 years. So yeah, it's not great news at all. And there's certainly been times where this has diverged, where the returns have been higher than projected. I see times, Derek, right, like 2003 to maybe 2000.
Well, even right now, I mean, where it is right now, you said it was probably close to 9. I think the forecast would have been 4.5 to 5. So it actually doubled what was projected. So
yeah, so it's more the trends seem to have been lined up going all the way back to, he's got back to 1928 here. So yeah, and the things that drive this, right? The data that he's using is doing things like looking at tenure bond rate. He's looking at what does he got there? What's that data point? 63% of the T-bill yield. Yeah. So like this is, I mean, I don't know if you've ever posted this in the show notes before, Derek, but it might be worth looking at that, like letting folks see this thing. And look, if you're someone who's, like, well, I'm thinking of retiring in the next 5 or 6 years, and then you're trying to figure out what you're going to make for the next 20 after that, this is one of those data points that, should help you decide or help, inform you a little bit as to kind of your forward growth rate, right? Because that's important, right? When you're planning on, how much you need to make so that, things like retirement can come into play. It matters, right? So I think that's where this is useful. I think if you're not thinking about retiring yet, I know you're not, Derek, I know I'm not, then maybe this is something that's good when we speak to other people. But it might be interesting to post this, Derek, because I think there's some use in this.
Yeah, I've actually extended an offer to have him on. I'll see if someday he takes that up. But I really like his stuff, and even if you disagree with him, it's so detailed, the pieces that he puts out. So it's really interesting. But Jay, here's some good news. Nick Majulia on Twitter pointed out that you know what, we really do have it better today than we did years ago. And just to show you that it's not all bad today, did you know that global youth mortality rates in the 1950s were 27%? Today, or at least through 2017, global youth mortality rates are only 4.6%. And for a long time, it was like 46%. Things are better today. Like, I know things don't seem that great sometimes, and people go on TV and social media, but, life expectancy is going up, infant mortality is going down, world poverty is dropping. So don't let everybody tell you that everything's really bad, Jay. How's that?
I like that. You finish on a strong note here, Derek. I like that. It is better. That is true. Some things are just better.
I'll start. I have I'm going to double down on my Zeke Fox, spelled Faux, number go up. It's the story of, sort of Sam Bankman-Fried. The trial is starting today. The first line in his book is, quote, "I'm not going to lie, Sam Bankman-Fried told me. This was a lie." Just classic. So
You're double counting on it. Excellent.
I started to read it. I'm going to give a full, maybe I'll extend an offer to have him come on as an author. I don't know. But I think this is great. And he even said, at some point, where did they say this? I forget what it is, but he's like, I would like to say that I'm the one who uncovered the fraud, but it wasn't me. I was taken in like everybody else. So number go up. I think it's so far. I'm really encouraged by it. And as a crypto skeptic, Jay, I couldn't be happier.
It's everybody loves to hear their own thoughts repeated back to them. That's true.
That's right.
Good.
Do you know Michael Lewis is taking some heat though? Do you know that?
Oh no,
he put out a book.
Really?
Well, I guess he put out a book and he went on 60 Minutes and seemed to be defending SBF and sort of, going against the guy. Is it John Ray, the guy who's supposed to untangle the whole, the guy they bring in to sort of clean up? Yeah, like I don't know. I don't know what's going on there with Michael Lewis. I haven't read his book, so to be fair, I don't know. But all right, Jay, let's go to yours.
Yes, real quick. I will double down on Foundation on Apple. I finished it. It finished really strong. So if you like sci-fi, you really want to pay attention to it's kind of like Star Wars meets Game of Thrones without the gore. So I would double down on that one. If you haven't looked at it yet, catch it, give it time. It's worth it.
How many episodes in? Like you got to let it season a bit, done. Like 3, 4?
No. Yeah, give it. No, I think it's interesting all around. Beautifully done. Great story. Just, it's not too hard to stick with, really.
Okay. Jay, next week we'll get back on the volatility horse. We simply ran out of time with all the talk about rates, but rates is driving things now. Jay, thanks again for coming on, and we'll talk to everyone real soon.